Everyone, it's Zach back with a new mortgage video. If this is your first time seeing one of my videos, welcome to my channel where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So hope you're all having a happy Friday out there. However, it has not been a happy Friday for those following mortgage rates, as they have gone up substantially as the result of jobs data that came out today. So I wanted to explain exactly why we've seen that movement and kind of my thoughts about mortgage rates moving forward. So I think it's important to take a step back and try to explain why today's news was so critical. Up until the past maybe 2 or 3 months, the most important thing that the Fed and therefore the market, which is how mortgage rates are derived, has been focused on is inflation. And that means that CPI, Consumer Price Index, has generally been the biggest market influencer because that's the first major inflation report that comes out. Now that has shifted over the past few months because inflation has come down considerably to a range that's at least close to where the Fed wants it to be. The focus has shifted to jobs market, and especially because the jobs data had been worsening. Unemployment ticked up, and that's when we saw a huge overreaction in a positive way. That was in early August for the July unemployment report and non-farm payrolls report. Because those came in a lot for unemployment higher than expected and for non-farm payrolls lower than expected, mortgage rates got a lot better. That showed job market was worsening and could signal a possible recession, which means the Fed would have to cut rates faster than anticipated. Today's report was the exact opposite. We had unemployment rate come in lower than the market expected, and we had non-farm payrolls come in over 100,000 higher than expected. And that's on it was about 250,000 versus 150,000 expected. So from percentage-wise standpoint, it's dramatically higher than expected. On top of that, you had ADP employment, which also shows job availability earlier in the week come in higher than expected. But really today's reports were what really jarred the market. And essentially, we are now looking at, as of this recording, a near certainty of no 50-point rate cut in November, which I always felt was pretty unlikely. But the market, as of last Friday, there was a near 50% probability of a 50-point rate cut. Today, that has gone from like 32% yesterday. So it had already been trickling down, but that went to 0 today after this report. And now there's actually a small percentage probability of a rate pause. I don't think that's likely to happen. And the reason for that is because I'm expecting next week we're getting Consumer Price Index, CPI, and I'm expecting that to come in pretty good, in part because I'm expecting year-over-year shelter to come down since we're replacing a very high month-over-month shelter number last year. And then probably more importantly, I do expect to see some uptick in unemployment and initial jobless claims, which typically feeds into unemployment in the upcoming weeks due to the recent hurricane. Though it's now been thoroughly outshadowed by today's news, quietly yesterday we saw a uptick in initial jobless claims, which is for the previous week. Hurricane Helen hit on September 26, which is Thursday of last week. So that means a couple days of the impact of that hurricane should have trickled into initial jobless claims this week. Next week, we'll have a full week of the impact of that hurricane, and I would expect initial jobs to pick up as a result of that. So all that to say, I don't think there's going to be a whole lot of movement from now until November when the Fed makes their decision. I think it's going to be a clear-cut 25 basis point cut. And because we've pretty much reached that consensus, I don't think there's going to be a big change in mortgage rates between now until then. Now, if something dramatically shifts, I'll certainly make another video to explain that, but that's what I'm seeing as of today. If you have any questions or comments, shoot them below, or feel free to call, text, or email me. But thanks for tuning into this video, and I will see you next time.